Okay, so as I said to you, being able to analyse the stance over the last 2 years and the reasons for the stance is probably the most important part of Chapter 12. So in this video, we're just going to look at some current fact questions you could get in relation to the monetary policy stance, as well as reasons for the RBA stance. So, with reference to current events, explain the reasoning behind the movement in the cash rate from 2016 to 2018. That's as far back as you're going to have to go. You may have to talk about 2016, but you wouldn't go any further than that. So, first of all, explain what they did. The RBA loosened the cash rate twice in 2016, from 2% to 1.5%. Since then, the RBA has maintained their expansionary stance, keeping the cash rate at a historically low 1.5% for the last 2 years. 1 mark. The main reason for the loosening in 2016 is the economy was growing quite slowly. Inflation was really low, below 2%. We had weak wage growth, and we had a high level of underutilisation. There's also slow mining investment, and the federal government was being contractionary as well. 1 mark. Okay, a couple of key reasons why they were expansionary in 2016. Low inflation, weak wage growth, and high underutilisation, or the government pursuing fiscal consolidation. All good reasons. In the last 2 years, the RBA has resisted further loosening the cash rate. Don't worry about that one. In terms of why they've done that, there's been signs of increased growth. So commodity prices have started to pick up. There's been less unemployment in the labour market. And headline underlying inflation now within our target range. However, there has still been signs that the economy is still not growing that strongly. So they haven't tightened monetary policy because we've still got slow wage growth. The tightening of lending standards has reduced demand, and the slight drop in housing prices. So basically what you're trying to do for this last mark is just say that there's been conflicting signs in the last 2 years. Conflicting signs, some things showing the economy is going better, that's likely to lead to higher inflation. Provide 1 or 2 examples. Higher commodity prices, the fall in unemployment. However, with slow wage growth and the drop in housing prices are 2 good examples. We've kept inflation, the interest rates the same. So what they've done in the last 3 years, why they dropped them in 2016, high levels of unemployment, underutilisation and weak wage growth. In this year and last year, they've kept it pretty much the same because there's been conflicting signs. There's still there's still slow wage growth, there's a drop in housing price, but on the flip side, commodity prices are increasing and the unemployment rate has fallen. Outline the RBA's most likely response if the government cuts income tax and increases government spending. Okay, so what that means by then is, what are they likely to do if the government cuts income taxes and increases government spending? Well, both of these things here are expansionary policies. So therefore, that may force the RBA to be more contractionary. So the RBA may be forced to implement a tightening of monetary policy if the government employs an expansionary policy, like lowering tax cuts. Explain why this might lead to inflation. So lower tax cuts will boost disposable income and could lead to increased aggregate demand and inflationary pressures. This will force the RBA to tighten monetary policy in order to keep inflation within 2 to 3%, always link it to their main goal. And increased government spending may also help to increase our productive capacity and reduce inflationary pressures. So they may be able to employ a more expansionary stance in the long term because the benefits for cost-push inflation in the long term, but because they're both expansionary policies, they may have to increase interest rates in the short term. Okay, this is the question we looked at in class. Explain how aggregate demand policies have influenced jobs and growth in 2017 and 2018. So this is the last question I'll go through in this video because it's a long one, 8 marks. As you can see, not answered very well, only an average of 3.6 out of 8. The key thing is, the first thing you need to know here is you're talking about, essentially, what have budgetary and monetary done to influence jobs and growth in 17-18. Okay, aggregate demand policies just means budgetary and monetary policy. So there's 4 marks associated to both. So in terms of an approach to this question, you don't really need to do the defining of monetary and budgetary policy. I wouldn't worry about that too much. First thing you want to do is explain what's happened to the cash rate in the last 2 years and what stance that implies. 1 mark. 2 marks for explaining why does that create jobs and growth. So when we have lower interest rates, why does that create jobs? Why does that create growth? Okay, and talk about it through 2 transmission mechanisms. People borrow more, people have more discretionary income. You could say the dollar depreciates if you want to. That's still an effective channel. 1 mark for explaining, well, why hasn't it been overly effective? Okay, because you're getting asked, well, how have these policies impact jobs and growth? So just to talk about the theory is not quite enough. You've got to actually articulate, well, have they actually helped jobs and growth? And there has been some benefit, but there's also been some weaknesses. Then your last 4 marks, what's the stance of budgetary policy been? Why have they taken that more contractionary stance? And then explain some policies that help to achieve jobs and growth. So the structural factors that have been more expansionary. So, in terms of monetary policy has been very expansionary. The cash rate has dropped to 1.5%. That's historically low. It's well below the neutral range of 3.5%. Lower interest rates act to stimulate aggregate demand, and through the 5 transmission mechanisms boost aggregate demand. For example, the lower cash rate has flowed through to variable interest rates and home loans, which has boosted consumers' discretionary incomes. Households may therefore choose to increase expenditure because they're armed with more cash after they pay their loans. In accordance with this, you could talk about people borrowing more. You could talk about the fact that the exchange rate is depreciated as well. When a component of aggregate demand increases, producers are going to produce more, and that generally flows on to more jobs or more employment in the economy. So you've got 2 marks there for explaining what the lower cash rate has done for creating jobs. However, despite record low interest rates, some households have preferred to pay off their debt rather than increase their spending, and other banks have refused to pass on the full rate cuts, which has limited the effectiveness. However, overall, unemployment has fallen from 5.8 to 5.3%, which is a sign that monetary policy's expansionary stance may have had some positive impacts. Budgetary policy, this 2017-18 budget has continued the government's commitment to fiscal consolidation with the aim of returning to surpluses in the next 5 years. Therefore, the budget can be considered mildly contractionary on the surface, as the deficit has gone from 18 billion to 14.5 billion. The government is injecting less into the economy relative to leakages compared to previous years. However, as we know, most of this is caused by cyclical factors, so you can articulate that we're not really being contractionary, it's just that the economy is going a bit better, which is helping the budget. While the size of the budget deficit was forecast to be smaller, this would generally indicate a mildly contractionary budgetary stance. The size of the structural deficit has actually increased, indicating that it's actually having a mildly expansionary effect on the economy. There's been plenty of expansionary policies, such as infrastructure projects like the Congestion Fund, the 7-year tax plan, which also helps to boost disposable incomes, which creates more jobs and growth, but also helps to boost our productive capacity in the long term. So again, this question is all about what do you know about monetary and budgetary policy? Show you know exactly what's happening in the economy at this point in time, what they're both trying to achieve, what the limitations are for this question. Explain why the government might claim that the delivery of a surplus budget helps deliver a more expansionary monetary policy setting. Well, by delivering a contractionary budget surplus, the government acts to slow down aggregate demand, which then allows the RBA to be more expansionary. So if the government decides to increase taxes or reduce welfare, this reduces inflationary pressures and allows the RBA to lower the cash rate without causing excessive inflation.